Good morning and welcome to the New York Small Business Development Center's webinar series. My name is Kathy Fitzmaurice. I'm from the central office and I'll be your host for today's webinar. Your microphones and telephones are currently muted to eliminate background noise during the program. You can ask questions at any time during the presentation. Just type them into your question pane, or you can raise your hand by clicking on the hand icon and I'll unmute you and you can ask your question. Today's program is being recorded and will be available through WebMQS in the Shared Resources section. Also, we'll have the PowerPoint and the spreadsheets available in Shared Resources as well. Today's webinar is being presented by Sam Candell. Sam's a advanced certified business advisor from our Mid-Hudson office. Thank you, Sam, and let's go ahead and get started.
Okay, good morning, everybody. Some of you must know me. I don't know who's on the line, but I've been with the Mid-Hudsons for 12 years. I don't presume that my methodology for doing financial projections is any better than yours, but I've been using a lot of these techniques for many years. I've been responsible for over $50 million worth of economic impact, so I've basically pulled the wool over the eyes of many financial executives and banks, so they actually believe the numbers that I present for my clients, or that my clients present for themselves with my help. I'm a firm believer that if you make the numbers look pretty, they have a little bit more credibility. So, typically people come to us and they bring us their business plans and they say, boy, I finished my business plan, it's great, except I'm having a lot of trouble with the numbers, or I don't know anything about the numbers. And it's really important to stress to these people that the most important part of their business plan are the numbers, because businesses succeed and fail on numbers alone. It's really the most important thing that they need to present with their plans to lenders and investors and stuff like that. So I'm going to walk you through a few scenarios of how I do things. Certainly they're no better or worse than anything that you do, but they work for me, and if there's something that you can pick up from from what I do, then if it's helpful, then that's a good thing. So as I said, that the first thing I do with the client, and most clients don't have a clue about finances. They're very good at describing what their business proposition is, but they're very bad at translate that into numbers. So many clients really don't have a clue about the importance of financial projections. So I try to illustrate basic concepts to them, what a profit and loss is, what a cash flow statement is, what a balance sheet is. I'll show them how to calculate loan interest and principal and stuff like that, so that they can start to feel comfortable working with numbers. A lot of people come in with guessing. Guessing is okay if you have no choice. But I tried to develop with them a methodology for coming up with some of the numbers in their financial projections. There are always things that you can make a phone call and make a phone call and ask a question to an insurance agency or an attorney, how much their fees are, an accountant, how much they're going to charge. So there's certain things that you can actually research and come up with, and then there's other things that are based on the assumptions in their business plans. So I tried to get them to come up with the lowest common denominator so that they can put some sort of formula together, especially as it relates to revenues, to come up with a revenue estimate, an A times B times C scenario. And I'll give you some examples of that. First reason one does the business plan and does financial projections is to determine the feasibility of their projects. I always say that I've talked more people out of doing what their intentions are than that actually move forward with their projects, because you have to determine whether it's feasible financially, and if it's not, then you either have to reevaluate your plan or decide not to give up your day job. So feasibility is an important conclusion that one can draw from financial projections. Bankability. Is the project bankable? Is your down payment big enough? Can it generate enough cash flow to support its activities, which includes paying back lenders typically or paying out to investors? You can determine the bankability of your project by doing well thought out financial projections. And then I always stress to the clients that in order to be successful in business, you have to watch the numbers. You have to have a meeting with yourself every once in a while or with your staff, and you have to look at what the numbers are, because they're the indication of how well your business is doing. It's like taking your temperature. If you have a fever, you have to do something about it. If your temperature is normal, then things are going according to plan. So what I tell them is that being in business is being proactive, which are the things you do, and being reactive, and what you're reacting to are what the numbers tell you. So if you rent a billboard on a major road and your business goes up 20%, then you know you've made a good business decision, and you can react to that by either doing it again or doing something similar. If you do the same thing and your business goes down 20% or doesn't increase, then obviously you can allocate those resources to something else that might have a more positive effect. And I didn't make up the quote on "you have to measure it to manage it." I think that was, I heard that first from Fred Harding, who was the first director that I worked for years and years ago, who isn't here anymore. But it's very true. The financials, which start with the projections, are a function of measuring things, and as you measure things, you have the ability to manage them. So it's really important to gather meaningful information in the process of putting a business plan together and financial projections. So I think I made up this quote. It says, the more meaningful information you gather, the more you mitigate the uncertainty of looking into the future, because financial projections are looking into the future, and the more real information you have, the more valid your projections will be. Whoops, wrong button. There we go. So I have some examples here that that hopefully will illustrate how I do things. So I taught Microsoft software for a number of years, so I was sort of had a head start on doing some of this stuff. I don't use complicated formulas or functions, although I do use some formulas and functions that are helpful. I think the key to what make these scenarios work for me is linking, because there's a lot of linking that goes on between the different tabs. If you notice, there's a lot of tabs on the bottom here. This is an example of a pretty generic 5-year pro forma for a new business, not an existing business. So, you know, I'll put in a company name, if I could get the caps to work, ABC Corp, and the person's name. And that shows up at the top here because it's linked to the spreadsheet. This is the profit and loss. You'll notice there's a P&L, there's a cash flow, and I'll show you the other tabs in a minute. This was actually somebody I worked with yesterday, so these are very preliminary. It's not ABC Corp, so I didn't violate confidentiality. But I leave room for different income streams depending on the kind of business it is. That'll become clearer later on. Cost of goods can vary. If there are variable costs associated with the projections for different income streams, they can vary as well. This calculates an average percentage cost of goods, an average percentage related to total sales for the various operating expenses that the business has. You'll note that there's a place for typical fixed expenses, owner's compensation, accounting. It's simply a matter of just putting in numbers. This is just the starting point for me. You can put anything into an Excel cell and it can become a real number. So for example, with payroll, I might do 15,000, what equal sign? Equals 15,000 times 1.18 because payroll taxes and everything else typically 18%, and you can come up with a number. So despite the fact that this is generic, you can manipulate these numbers in any way that's appropriate for any kind of client or any kind of business, and that goes with the same with the labels on the left-hand side. So it calculates the total operating expenses, net income, and it does a break-even, gives you a break-even number. I use the formula by dividing the gross profit percentage, which is here, into the fixed expenses, and that gives you a break-even. I do usually take out depreciation because it gives you a break-even on a cash basis, because as we all know, I hope, depreciation is not a cash expense. So this is an example how I'll start a projection with the startup company. I can do it for 3 years. I can do it for 5 years. It just all depends on the scenario and the expectation of the client and the expectation of the target audience for the projections. 3 years is a reasonable amount of time to look forward. Sometimes, people need to look forward longer than that. Let me see what the next one is. This was a projection that I did for an existing company. These numbers came from the tax return, which, and yes, I know restaurant is spelled incorrectly. I believe this was an Italian restaurant, pizza place. So these were the tax returns for those years, and this was their gross sales. They didn't break out into these other categories, catering and bar, which ultimately in the project moving forward, they were going to add catering to their business and a full-service bar. It's interesting. Never had that before. But anyway, so this adds up the total sales. It gives me, we did a pro forma for the year through April 30th, as you can see here. This is a function that gives me the average percentage of sales of the owner's compensation and all the other expenses for the 3 years in the actual. And that's just the starting point in the pro formas. Assuming the operations stay typically the same, then you can use those to calculate expenses moving forward, or you can actually just type in numbers. As you can see, I typed in 120,000. Evidently, the pizza business is very lucrative for some people. So this was a profit and loss for an existing company. We calculated the break-evens, what percentage of actual sales that is. All these numbers are useful in determining bankability and cash flow and things like that. So the next thing is cash flow. All these numbers here are linked to the profit and loss. This was their starting cash at the beginning of, actually I'll go to the pro forma. This was the, should type that in. Sorry. These were the pro formas. This was the starting cash position for the first year after the renovations. These numbers are linked to the profit and loss because they're the same. And then below the line are the other financing activities of the business. There's a place to put in revolving loans, bank loans, changes in accounts payable and accounts receivable, other short-term debt that they might have. Some of these are very rarely used. Usually it's a long-term loan that's reflected here, or a revolving loan, at least in my experience. This would be the equity contribution. So this would show that they had $500,000 available to execute the project. Loan principal here, I believe this was for half a year in this example, but my this one doesn't have it because I used it to print. But let me go back here. I have this amortization table as a tab on all of my spreadsheets. So they were borrowing $400,000, and I don't remember the percent, but you can put in the percent. It'll give you the amortization table for the loan. It'll give you the monthly loan payments based on the number of months or years. This is the interest and principal for the first 4 years. And I have another table called the loan summary where I have to actually paste the values in. And it fills this loan payment summary. And the reason I have to paste it in is because very often if there's more than one source of funds, this will give you the total debt service. But back to the example. So the loan principal is linked to the loan summary here, total principal. As we all know, loan principal isn't tax deductible, so it doesn't show up in your profit and loss. It's a negative number. Depreciation gets added back in because it's not a cash expense. This was the cost of the project, which is $500,000 to build a new building. For whatever reason, I put cost of sales down here. It's just the convention that I use, and this shows that at the end of the first year, they had $31,000 in positive cash flow. That number flows up to the top here, and the same process goes on all over again. Actually, I can see the project was extended over more than 1 year, but that's okay. Balance sheets. I love balance sheets. They never balance. I finally got them to, I finally got this one to balance appropriately. I think the biggest issue is when you have a client's tax return and you try to reconcile accounts payable, accounts receivable, and stuff like that. But, balance sheet is important to some businesses. Others, it's almost irrelevant.
Oh, Sam, we have a question.
Yeah.
Why is depreciation on the cash flow since it's non-cash?
It's added back here because it's up here on the profit and loss, so it's being deducted. So you have to add that back into the cash that's available because it's deducted as a deduction on the profit and loss. Does that make sense?
Does that make sense, Kim? Yes, thank you, Sam.
It's not something you write a check for, so you have to add it back into the cash flow of the business. Just because of the way the profit and loss and the cash flow statement are linked up, you have to add it back. Okay, so where was I? A balance sheet for our typical clients typically doesn't have all that much meaning, but banks love them, so you have to find one way or another to make them balance. This one happens to balance. This is just where I check total assets versus total liabilities. Some of this stuff is linked to the other sheets, some of it isn't. All of my projections explode out into monthly numbers. This is really not the best example of that. I'm going to go back to this one. You'll note up here there's percentages. This is for seasonality. So in this particular case, 7% of their total sales was going to be in January, and 10% was going to be in November, and it always adds up to 100%. This helps with determining monthly profit and loss, but more importantly, it also helps determine monthly. This is not a good example because it's not a completed financial projection, but it also shows you monthly cash flow so that you can manage your finances on a month-to-month basis, or at least project them into the future. So this is my methodology for working with either an existing company or a startup company. It gives you an opportunity to manipulate numbers in any way whatsoever, because that's, I think, the most important lesson that I have to teach my clients, is that their businesses are dependent on numbers to be successful, not how good their recipes are or how wonderful their product is or how beautiful the clothes they make, but they have to turn that into a business model that's going to work, and the reflection of that is going to be in the financials that they put together for it. And also, obviously, if they're going after financing, they have to put their business in the best light so that investors or lenders are going to be willing to lend them money. So, if you make them look pretty, they're more understandable, and if they look logical, hopefully they are logical, and that's certainly a good part of the equation. So I'm going to close this one for now, and I'm going to show you an example of what I would do for a restaurant. Okay. This is a good example of developing a methodology for coming up with numbers. Okay. So I created this tab on my restaurant worksheet, and believe me, I get a lot of restaurants to come through here. So rather than sitting and reinventing the wheel all the time, this is a good way to illustrate to your clients who have no ideas about numbers. They know about tablespoons and cups and ounces and stuff like that, but they don't know much about numbers, of how they can calculate what their payroll expenses are. So I like to, at least where we are, there's lots of different seasons, and seasonality is an important thing to consider in putting these financial projections together. So when I did this one, there was a winter, a spring, a summer, and a fall season, and there was a 15 weeks, 15 weeks, 10 weeks, and 12 weeks as I defined with this client. These numbers are not real. I just put them in to show you how they calculate. You can put various different positions in here as relates to a restaurant. You can change the labels to whatever is required for any particular kind of operation. Some people just have 3 staffers. Some people have no 8 staff. It's just a placeholder for numbers. So you can put an hourly rate. You can put the number of hours they work every week, this would be their total weekly paycheck. This would be the number of weeks in the season, actually the number of weeks in the season, and this would be the total pay for this person for the 15 weeks of the winter season, and then you would add it up and you get this number. Same thing for the other seasons. At the bottom, it calculates total payroll. That is linked to the profit and loss, and I multiplied it by 1.18 to include payroll taxes. You can have a separate line item for payroll taxes if that floats your boat or whatever, but that's a useful thing. It's useful to make your job easier. It's also useful to illustrate to the client how to come up with a good number for payroll. Very often they guess. This is a worksheet for coming up with revenues. Okay. I use it because I'm familiar with it. For some, it's too complicated. But basically, when you're dealing with restaurants, you're dealing with seats. You're dealing with an average check or an average ticket per person, how many times they turn the tables. Beverage and food have different costs of goods, which is important to take into consideration. So this gives you total sales, the food portion, the beverage portion, and a weekly number. Cost of goods is based on the 20%. For beverage is the 20% here. You can change these numbers and it'll change the calculation. And same thing for food. It totals up for the week, and it gives you the cost of goods, which is based on 36% here. Okay. It adds it up. It gives you a calculation for the total season, which in this case was 16 weeks. Okay. You can adjust for different days of the week because the flow in and out of a restaurant varies from day to day during the week. And this is set up for a summer season and an off season for breakfast. Again, it can be modified any way that's appropriate for any particular client. Then it calculates the same for lunch. Obviously, if you don't serve breakfast, you can just zero out these numbers and they won't show up. Lunch is a similar scenario. Lunch checks typically bigger than breakfast checks, so these numbers are higher. Obviously, they would turn the tables more times on Friday, Saturday, and Sunday, so this is 2 times instead of 1 time. Gives you the opportunity to do the same for dinner. And if there's a separate bar, it gives you an opportunity to calculate for the bar and catering. The way I do catering is with events. Some places will charge a room fee for if they have an empty room that they use, and it's usually a fixed fee per person. All of this gets summarized at the top here. And the total is about $880,000 worth of sales. This is a big restaurant. 16.5% is breakfast, 43.1% is lunch, 32.9% is dinner, so on and so forth. Adds up to 100%. And those numbers are linked to the profit and loss here. Okay, and then the expenses would get filled in here based on, again, a methodology that you go over with the client. So the owners never make any money, but you can put some money in there, and all these other things can get filled in appropriately based on the assumptions in the business plan. But when they're writing the business plan, they're basically going to be describing the assumptions that are in the worksheet. And then it will calculate cash flow similarly to the other spreadsheet that I showed you, and then it can adjust for monthly variations in cash flow. And the amortization table is there, the loan summary is there, and it all links together. Sometimes it works, sometimes it doesn't. I always have my clients, if they're going to be working with this themselves, send it back to me so I can make sure that all the links work properly and that the numbers make sense. And then when we meet again, we go over these to determine either feasibility or whether there are things that have to change or whether the assumptions are sound or whatever. But, and, you know, it helps people to see what's involved in running a business as a restaurant as opposed to being a chef who knows how to cook. So it's really important. Anybody have any questions? So that's a restaurant. Let's see this one. This is a rather large project. The name is gone, to protect the innocent, but it happens to be a real project. Whoop! I'll take that off. You didn't see that. So this is a rather large hotel project. A lot of this information was provided by the client, which made my job a lot easier. It's a 101-room hotel. They supplied a lot of numbers, which in terms of the project, I put them into this little worksheet in terms of summarizing it all. This is pre-construction expenses. These are construction expenses based on, right now it's a guesstimate, but ultimately they'll be getting an estimate from a contractor to do this. These are the other expenses. So this is the total construction budget, financing expenses, construction interest, franchise fees to their franchisor, and closing costs, and then furniture, fixtures, and equipment, which some of this is a work in progress, and this summarizes the whole project. It's a $10 million project. We're hoping to get 85% financing with $1.5 million in equity. With the cost per room, this calculates a cost per room. Some banks work with that number, and if it exceeds what they're comfortable with, then you're not going to get a loan. So it just varies from bank to bank. But anyway, this summarizes the project, and certainly it's echoed in the rest of the financial projections. This is the profit and loss that was put together. It's a little bit more complicated than the ones that I showed you because it breaks it down into administrative costs, insurance costs, marketing, different departments, payroll, room supply. These are typical ways of breaking down a profit and loss for for this kind of business. And at the bottom, we came up with net income, which was positive. Break even, again, we took out depreciation because it's not a cash expense, and we came up with a break even number of $1.7 million in sales a year, which is about 63% of what their projection is, which is right here, which is 2.7 million. Okay. Based on their average daily room rate, this calculates how many room nights they're projecting to sell. Okay, that's the vernacular of hotels. The second year with a 3% increase, and this calculates that calculates the percentage increase from year to year. They're projecting a 3% increase in sales, which is a 3% increase in room nights that they're going to sell, and another 3% in the third year. So again, a spreadsheet is your friend. Excel is your friend. You can use it to manipulate numbers, to illustrate points, to illustrate in numbers the assumptions that are in the written part of the business plan or in your clients' heads, for that matter. Their projected average daily room rate was $129 a night. They have 101 rooms available. That's a total room nights. If every room was rented, of 36,865 room nights. The lenders wanted us to work with a 58% occupancy rate, which yields this amount of revenue, which is this number of room nights. Oh, I'm sorry. This was the projected amount. This is the total number of room nights this echoes what's over on the left side of the spreadsheet. That's 411 a week and 59 a day. So that's about 58% occupancy. And this is the break even.
Sam, I'm sorry, we've got another question. Is it always
okay.
3%? Is it always 3% per year for a good grow number?
No, that's a number we decided to use. If you notice, in the formula here, it's 1.03. I could have made it 1.10 and increased it by 10%, and it will adjust the number accordingly. That's the way I do it. You could do it the other way, too. You could put the 10% there, and you could use that as a calculation. So, no, that's not a rule. So the average daily room rate is still 129. These numbers stay the same. Based on the break-even number down here, in order to break even, this is the number of room nights they have to sell, 13,523. So this is what they projected, and this is what they have to sell in order to break even. So that's 37 a day or 260 a week. 13,523 a year. Depending on where I live, which is rural, up in the Catskills, this happens to be a small city hotel, so that's a reasonable number. But I'll be working with people, and if you're considering 7-day weeks instead of just weekends or whatever, if you're working with there's different ways to think about it. If you're working with a bed and breakfast in Woodstock where I live, then you might think of the week as only 3 days, which is Friday, Saturday, and Sunday. So it really doesn't matter. It just depends on how you construct the formula to come up with those numbers. So in this case, 37% is a reasonable occupancy rate based on the experience of these owners who are pretty sophisticated and have done this many times before. So this is the profit and loss. This is the cash flow for this project. Obviously, it's a startup, so they don't really start with a cash balance. At least that's the way I represent it here. Again, these expenses mirror what's in the profit and loss. This is the total financing. This is the total equity contribution. This is the loan principal, which again is here from the loan payment summary, which comes from the amortization table here. Okay. So this is the loan principal. Again, loan principal isn't tax deductible, so it doesn't show up in your profit and loss. Add back depreciation again. Again, that's not a cash expense, so you have to add it back in because you're not writing a check for it. This summarizes the other costs that we had on that table, including the pre-construction, the construction cost, financing fees. This was on the worksheet that I showed you at the beginning. This was what it cost to buy the land. And you can see that at the end of the first year, based on their projection, not based on the break-even, they have positive cash flow of $645,000. From my mouth to God's ears, that's all I can say. But it does show positive cash flow, and that's how you begin the second year. And again, just like your bank statement, it goes through. But obviously in the second year, there's no construction or anything. So we're just going to be deducting the loan principal and adding back the depreciation. And this would be the end of the second year and the third year and so forth. Again, this is basically the same scenario by month. We came up with these numbers for seasonality based on their experience. Summer is busier than winter, typically. These numbers mirror what's on the annual profit and loss. Only difference here, and again, this just shows that you can modify these basic sheets to satisfy the needs of any individual client. It shows the number of room nights per month here based on these percentages here. Okay, and the same with the cash flow. You can see that based on those percentages, cash flow fluctuates from month to month. They're very flush with cash during the summer. And that certainly at the beginning of the project, they don't have a lot of cash, but that just accumulates. And one way to check your work is to make sure that the end of the first year on the monthlies is the same as the number on the annual numbers. It's just a way to check the math. So this is a 3-year one. It's not a 5-year one. The balance sheet balances, which is always a miracle. So this is one for a pretty fancy, pretty large project. Basic fundamental assumptions just change in magnitude, but they don't change in definition. So it's really just a question of bigger numbers usually more than anything else. There was one other thing I wanted to show you. I do include a sheet of basic financial ratios. I have to tell you that I've been doing this for 12 years, and I've had maybe 3 clients where these ratios really had any meaning. I hate it when banks throw them back in my face and they say, listen, it's a startup company, it has no operating history, and these definitions don't really apply to them. But it is what it is. I put links here to descriptions so that if clients have the spreadsheet and they're working on it, they can understand the ratios. And frankly, I can look up the definitions too and say, oh yeah, I remember what that means. And so this is helpful for some kinds of projects that actually, where these actually have some validity. Honestly, for me, they very rarely have any validity. So that's just the way that is. And I think I've covered everything that I wanted to cover. I talked longer than I thought I would be able to, so now I can answer your questions. I'd be glad to share this with anybody. I'd be glad to go over it with them over the phone. I'd be glad to fix it if you use it and it gets screwed up, because ultimately the goal is to be as helpful to clients as possible. This works for me. It may not work for you. But I hope it was helpful, and I think I'm finished.
Thank you, Sam. It was great. Let's see. We've got a question from Beth. Hold on a second.
It's a very ambiguous question.
I've unmuted you, Beth. You can go ahead and ask your question. Or type it into the question panel. Or you could call Sam afterwards and ask.
I don't accept phone calls.
You just said you did. Any other questions for Sam? Oh, we've got lots of thank yous and excellent. So I think we're done. So thank you again. Thank you very much, Sam. That's wonderful. So again, this was recorded, and we will put everything in shared resources.
I will endeavor to clean these up a little bit. I might have to, and then I will share them with everybody. And again, if you have any questions ever, just give me a buzz.
Thank you. Thank you again, Sam. Thank you, everybody, for joining us today, and hope you have a great day and a great rest of the week.